Hello and welcome back to another episode of Magnified, the Antipodes quarterly deep dive into global markets and the Antipodes global strategies. Today I'm joined once again by co-portfolio manager Vihari Ross. Vihari, welcome.
Thank you for having me, Sam.
Over the fourth quarter of 2024, global equities were down around 1% in US dollar terms, however finished higher around 11% in Aussie dollar terms due to exchange rate impacts. It was a fairly muted finish to what was a strong calendar year, with the news of the incoming Trump presidency and diminished expectations of the central bank easing in 2025. US equities outperformed over the period, led again by large cap technology stocks. The outperformance of the Magnificent 7 technology stocks drove these returns, with the cohort up around 10% in US dollar terms. This really contrasts with the remaining 493 companies in the S&P 500, which together returned negative 1.5% in US dollar terms, which really highlights the current concentrated nature of returns in the US market. To put this into context, the top 10 stocks in the US now account for 32% of the S&P's market cap. Given the US now accounts for around 70% of the global index, whether the MSCI All Country World Index can sustain the same pace of growth into 2025 largely depends on whether the US can pull off higher tariff, tax cuts, lower inflation, and rate cuts at the same time. Now, Vihari, it's almost impossible to talk about the fourth quarter without talking about Donald Trump's decisive election victory. Now, all throughout the campaign, he's been pretty clear and pretty consistent. He wants higher tariffs, less immigration, lower taxes, lower regulation, and now lower policy rates. How are we sort of firming for some of these key policies, and how is it different to perhaps Trump 1.0?
Yeah, look, I think we don't know what Trump 2.0 holds, but as you pointed out, he has had a lot of rhetoric, over this campaign. I think one of the big differences from 1.0 is that Trump is inheriting a very different economy this time around compared to 2016. We're dealing with, the Fed trying to navigate rate cuts, trying to navigate a weakening economy, and, managing inflation, managing employment, and the market is swinging in terms of what it's focusing on. If we think about what Trump brings to the table there, getting rid of low-cost workers through migration policies, adding a tax on the consumer through tariffs, these are inflationary by their nature, and companies that have the pricing power to do so will pass that on to the consumer and potentially create risk. And I think it does make that Fed's job a lot more difficult. In the context of that, I think the market's currently now focusing more on that stickier inflation type dynamic that's playing out, because meanwhile the employment type dynamic that we were worried about 3 months ago is proving to be very strong. And so perhaps there won't be as many rate cuts as was priced in, 3, 4, 6 months ago. And why does that matter? It matters because of what's priced in. What's been priced into the US economy is continued exuberance, a continued, soft and benign outcome. And of course, if rates do stay that little bit higher because of stickier inflation and because of Trump's policies impacting that as well, that does have implications for growth assets, and it does have implications for the cohort of the US economy that is highly levered as well and was probably holding out maybe for those, those lower rates to come and save the day.
So a bit of uncertainty perhaps coming our way in 2025. Vihari, most clients watching would be fairly familiar with the fact that a pragmatic value portfolio generally has a broad range of contributors. That was no different over the quarter. Particularly Europe was positive for the portfolio.
Yeah, Sam, I think we had a number of contributors in Europe. The biggest was Siemens Energy. That was up, 320% over the last 12 months. And that's a business that did have those extraordinary losses in the prior year. Now it's returned to profitability. It's returned to that 10% revenue growth profile, margin expansion. It's obviously, wind is a key, enabling technology in the energy transition, and the market certainly, valuing it as such, particularly given, the, AI demands for energy and green energy increase. We also had a positive contributor in Europe from European banks. NatWest was up by 50%. They also did a £1 billion buyback from the government over the last 12 months, and that's really positive move in terms of the ongoing privatisation of that business. We also had a positive contribution from Societe Generale, the French bank, benefiting from that steepening rate curve, more than 10% revenue growth delivered, beating market expectations as well.
And Vihari in the US, a beneficiary of the Trump trade?
Yeah, so we had Capital One, deliver a positive contribution as well. That's a business that with Trump in power now, we're expecting that lighter hand in terms of regulation to take place, which is going to increase the probability of their merger with Discover Financial going through, and they'll be that end-to-end credit card provider, in fact the largest in terms of outstanding credit card balances in the US, and rivaling the scale of companies like American Express and JP Morgan, and trading at a single-digit multiple as well. So that's been a positive contributor over the period too.
And conversely, some weakness from emerging markets, most notably China, giving back some of those gains from late in the September quarter. But there was a bounce late in December.
Yeah, Sam. So in fact, China was up by 8% in December, but was up 4% over the quarter, reflecting that that weaker October and November. I think what we're seeing with China is that there's been that impact of that confidence around the stimulus and the desire to create that bottoming in the property sector, to provide direct stimulus to the consumer in China. And we are going to get more information on that, the next MPC conference in March, to see that CCP's willingness to support that nascent recovery. We've started to see, the other thing about China that's worth pointing out, particularly given the Trump conversation we've just had, is that the tariffs are a tax on American companies seeking to import from China, as opposed to that, a tax on Chinese companies. And I'd say that Chinese companies, are well aware of this and have actually been repositioning their businesses sort of away from the US, or diversifying from the US, for the last decade. And in fact, the US is only 15% of exports to China. So that's something else to keep in mind. Where China's gone instead has tended to be, in a form of soft power to emerging markets like Africa and Latin America instead.
And Vihari, you just mentioned Latin America, a little bit more uncertainty coming out of Brazil.
Yeah, Brazil was actually down 9% in the fourth quarter. That was really driven by concern around the direction of interest rates. Previously we had that, downward trajectory. Now it's facing an upward trajectory off the back of, President Lula being a little bit more free spending, and perhaps, changing their sort of their fiscal position in a negative sense. That did affect our investment in Sendas Distribuidora, the cash and carry retailer in Brazil. Ultimately we've retained that position. It's still a stock trading at 11 times, growing at 33% per annum, and highly cash generative business that will pay down that debt, even with a higher rate profile in Brazil.
Sure, and just wrapping up, contributors and detractors, it'd be remiss not to mention that the fact that the portfolios didn't hold NVIDIA, Apple, Tesla and Broadcom over the quarter did lead to that underperformance. Vihari, some of the portfolio changes over the quarter. Let's start in the US on the back of Trump's election win.
Yeah, so in the US, we added to our financials exposure. That included Ally Financial, in the credit card and auto space, adding to exposure in Capital One, which I already spoke about. Both of these stocks are Trump beneficiaries in the form of lower tax and lower regulation. There's also, unlikely to be more onerous capital requirements for financials under a Trump administration, and that certainly supports, the potential capital return profile and also potential loan growth of providers like Capital One and Ally. The other one we added to was EQT. That's the largest US provider of natural gas, and there's certainly, again, a bit of a Trump beneficiary in the greater export of natural gas from the US. And the third one I'll mention is Cemex. That's actually not an American stock. It's actually a Mexican cement producer, exporting into the US cement, and benefiting from that demand profile as that US infrastructure spend takes place, which is only going to intensify, given the US is a net importer of cement. Cemex is a key provider there, and trading at 7 times, you're more than adequately being compensated for any potential tariff risk, particularly in the context of that substantial demand profile.
Vihari, we've spoken about the mega cap tech space already. The moves over the quarter really catalysed a rotation within the portfolios in our own expressions of the cloud and the AI monetization, a key structural trend within portfolios.
Yeah, so that's right. There was a bit of a rotation in the portfolio in mega tech. We took the opportunity to exit, our long-held position in Meta, and we also trimmed Oracle. At the same time, we added to our positions in Alphabet and Microsoft. In the case of Meta, as I said, it's been a long-held position, but it's a business that is a little bit economically sensitive there, being exposed to the ad market and is facing some headwinds there. But at the same time, taking up, increased costs, increased capex, as it strives to become a leader in AI technology. And essentially, it got to 25 times, trading at a premium to its history, and it was time to move that capital elsewhere. In the case of Oracle, it was a strong performer and ran to over 30 times, so it was an opportunistic moment to trim that position.
And the adds to Alphabet and Microsoft?
Yeah, Alphabet is the only tech stock to have an integrated AI capability through its proprietary large language models, through hardware and application layers as well. It's a business that was potentially a little bit written off around ChatGPT disrupting its search platform, but in fact there's evidence that the search platform is being strengthened by its internal AI capabilities, not only in terms of usage but also time spent. And to boot, there's other growth avenues for this business as well, being Google Cloud, being businesses like YouTube. And you've got a business here that is trading at a 19 times multiple. It's growing faster than the S&P, but priced at a discount to the S&P. In the case of Microsoft, that's a winner across the cloud and AI, and that's across hardware, it's across infrastructure, as well as applications. And the thing about Microsoft is that it has lagged a bit, due to a little bit of a slowing in growth in the Azure platform, but we're really expecting that to start to re-accelerate in 2025 and to the benefit of the share price.
And Vihari, what about in the semiconductor space or the hardware space?
Yeah, so in hardware, we retain our position in TSMC. That's a business, at its most recent results, continuing to deliver that 20% CAGR in its revenue over the next 5 years. And within that, the AI component of its revenue is growing at a 45% per annum over the next 5 years. Also in hardware, we exited our position in Samsung in favour of Keysight Technologies. Samsung has been a laggard, and we do think its memory capability will enable it to be a supplier ultimately to NVIDIA and the other hyperscalers. But that time isn't now, and it made sense to redeploy that capital towards companies like Keysight, which is a global supplier of electronic testing and measurement equipment. Their order book is really inflecting positively at this point in time in key end markets, to the hyperscalers, to aeronautics, as well as to telecommunications with the rollout of 6G technology as well. And that's really reflecting positively in the revenue growth profile of that stock.
Vihari, you touched on it earlier, China, still a little bit of uncertainty coming out of the region, but we have seen steps over the quarter to further stabilise the property sector and directly stimulate the consumer, things like the appliance buyback program. How's the portfolio positioned in China looking forward? Yeah,
so China is still about 13% of our global portfolios, but we did take that strong bounce in late September and early October into account, and we took the opportunity to trim positions or exit positions where our price targets had been met. That includes stocks like Ping An, Tsingtao Brewery, Cattle and Baidu. We also added to our position in Didi, the car hailing application in China, that has 75% market share, and we're poised for the profit to really inflect positively in that stock, through higher take rates and through things like their food delivery and international operations, which were loss-making, moving into profit-making territory as well.
And Vihari, the global portfolios retain that overweight positioning in Europe, but importantly, that positioning is not premised on any view on the macroeconomy.
Yeah, our positions in Europe tend to be multinational businesses, businesses that could be listed anywhere in the world, and certainly if they were listed in the US would command a premium multiple. But what we have there are, positions based on our detailed industry work, based on stock-specific views. And our positions are really anchored around a few key pillars. Our industrials exposure includes businesses like Siemens Energy, which I mentioned earlier, Siemens AG, the digital automation business, Airbus in global aeronautics. We also have financials exposure, NatWest and Societe Generale that I mentioned, and also global pharmaceutical business Sanofi. And each of these businesses is trading at a discount relative to its history, relative to their business resilience and growth profile, and importantly, trading at a discount relative to peers in other parts of the world.
Now, looking forward briefly to the rest of 2025, now there are reasons to be optimistic around some of the more benign data coming out of the US, but President Trump still represents a bit of uncertainty. The US overall, Vihari trading at still 22 times, a significant premium to the rest of the world, and after 2 very strong calendar years of returns, where do you sit this year? Optimistic or pessimistic?
So I think, Sam, look, we've come off of, the top 7 companies generating over 60% return in the last year, the other 493 delivering only 10. That level of exuberance, does create some risk and reticence on my part, at the index level. But at the same time, the other side of the coin there is that there's a whole bunch of companies that didn't participate in those concentrated market returns. And what I'm expecting to see, as that concentration dissipates, is a broadening out of those sources of alpha and the sources of performance. And on that basis, I'm actually very optimistic because this is a very positive thing for broader market participation and for the value factor in general as well. And that's not only going to be driven from the US, it's going to be driven from other markets around the world as well, including Europe and emerging markets to boot.
And I encourage everyone to look out for the next episode of the Antipodes Good Value Briefing with a bit more of a comprehensive outlook into 2025. Well, Vihari, thanks again for joining us on the Magnified quarterly video series.
Thanks, Sam.
And thanks everyone for tuning in. See you again next quarter.